Trillions of dollars in volume trade hands on Wall Street every single day. Yet 90% of retail traders only look at price. Did the candle go up? Did it go down? They never ask the one question that matters. How much money and how many hands actually moved behind this candle? That gap is exactly why institutional players, hedge funds, market makers, the big banks, stay one step ahead of retail traders. They don't just read price, they read volume. In this video, we're breaking down three things in detail. 1. The difference between volume and price, and why it actually matters. 2. The effort versus result mental model, the framework institutional traders use to read the tape. 3. 3 volume patterns you can identify on any chart: stopping volume, buying climax, and volume divergence. This isn't a motivational video. This is a practical, analytical breakdown. Take notes because we're going to walk through every concept with real market examples. Part 1. The difference between volume and price. Let's start with the fundamentals, but go deeper than most people do. Price tells you what happened. Volume tells you how much truth is behind it. Say a stock, Advanced Micro Devices, AMD, for example, moves up 3% in a single day. A trader who only watches price says, bullish move, buy it. But if that move happened on just 40% of average daily volume, the move is weak. It means big players aren't participating. Now take that same 3% move, but it happens on 200% of average volume, double the normal turnover. That's a completely different story. It means institutional money is actively backing that move. Here's a principle worth sitting with. Volume tends to move before price does. Richard Wyckoff, who developed this framework in the early 1900s, showed that before any major trend reversal, smart money, the large institutional players, quietly build their positions. They try to hide their buying or selling so price doesn't move too much while they're doing it. This is called accumulation, when big players are buying, and distribution when big players are selling. Case study. In March 2020, during the COVID crash, in the days before the S&P 500 put in its bottom, price kept falling, but selling volume was quietly shrinking each day. That's a classic sign that selling pressure is running out, even while price is still going down. Second example. In late 2020, in the weeks before Tesla was added to the S&P 500 index, the stock saw a sharp, sustained increase in volume. That was a signal of institutional rebalancing and index fund buying, a completely different pattern from normal retail activity. Why this matters. Price tells you the direction of the trend, but volume tells you how much conviction is actually behind it. Low volume moves are often fake breakouts or traps. High volume moves are usually more sustainable because there's real capital commitment behind them. Next time you open a chart, don't just look at the color of the candle. Look at the volume bars underneath it. If price is moving but volume is flat, stop. Ask why. Part 2. Effort versus result, the core mental model. Now let's get into a mental model that forms the foundation of all volume analysis: effort versus result. Think of it this way. Imagine you're pushing a heavy car. If you put in maximum effort, full force, and the car barely moves, something's wrong. Maybe the brakes are on. Maybe there's an obstacle you can't see. In financial markets, effort equals volume. How much money, how many shares, how much participation. Result equals price movement. How much the chart actually moved. When effort and result match, the market is moving in a healthy, genuine direction. But when there's a mismatch between the two, that's one of the biggest signals institutional behavior gives you. 4 combinations to understand. 1. High effort, high result. Heavy volume paired with a large price move. This signals a healthy, sustainable trend. Example: when Nvidia gapped up 24% following its Q2 2023 earnings report, volume that day ran roughly 5 times the stock's average. Both effort and result were large. The move was genuine. 2. High effort, low result. This is where the real signal hides. Heavy volume comes in, but price barely moves. That means some force, buyers or sellers, is absorbing the move and holding it back. This often precedes a reversal. Case study. In December 2018, during a sharp bear market in US equities, the S&P 500 had a day with extremely heavy selling volume, but the index didn't fall nearly as much as that volume would suggest. Within weeks, the market bottomed and reversed. High effort, low result. Sellers were running out of strength, even though it wasn't obvious at the time. 3. Low effort, high result. A large price move on low volume. This is the riskiest signal of all. It often happens in illiquid conditions, pre-market, after-hours trading, or thinly traded small-cap stocks. These moves reverse easily because there's no real participation backing them. 4. Low effort, low result. This simply signals a lack of conviction in either direction, a consolidation phase. Neither buyers nor sellers are actively engaged. Here's the key point. Most retail traders only look at result, price. They never analyze effort, volume. That's exactly why they miss the warning signs ahead of major reversals and end up buying or selling at the wrong time, right alongside the herd. Institutional traders do the opposite. They constantly ask, how genuine is the effort behind this move? That question is what separates an informed trader from a herd follower. Part 3. 3 key volume patterns. Now let's go deep on 3 specific patterns you can identify yourself on any chart. Pattern 1. Stopping volume. Stopping volume happens when, during a strong downtrend, an unusually heavy volume spike hits, but price stops falling or sharply reverses. It signals that large buyers have absorbed the selling pressure, buying up enough supply to stop the market from falling further. How to spot it. Occurs at the end of an extended downtrend, a day where volume is far above average. Price opens lower and closes higher that day, or forms a long lower wick, a long shadow beneath the candle. Case study. During the COVID crash on March 23, 2020, the S&P 500 saw an extremely heavy selling day, and that same day marked the market's bottom. A sustained rally followed over the next several weeks. This is a textbook example of stopping volume. Large buyers stepped in amid heavy selling. Pattern 2. Buying climax. A buying climax is the opposite. It occurs at the end of a strong uptrend, when price surges upward on extremely high volume. But that surge often turns out to be the final push of the trend, right before a reversal. Think about the psychology here. Retail traders are at their most excited during this moment. FOMO, fear of missing out, is at its peak. This is exactly when institutional players tend to distribute their positions, selling in large size, using the flood of retail demand to exit. How to spot it. Occurs after an extended uptrend. A parabolic move, a sharp, near-vertical rise. Volume peaks, often on the final days of the move. Afterward, price goes sideways or declines, even while volume is still elevated. Case study. GameStop in January 2021 is an extreme example. The stock hit $483 on massive retail volume, and within days, it crashed more than 80%. That final push on record volume was a textbook buying climax. A quieter example. After earnings, when a stock gaps up for several consecutive days and the final day carries the heaviest volume yet, but price doesn't rise as much as it did the day before, that's an early warning sign that momentum is fading. Pattern 3. Volume divergence. This third pattern is the most subtle, but just as powerful. Volume divergence happens when price makes new highs or new lows, but the volume supporting that move keeps shrinking. Bullish divergence. Price makes new lows, but each new low comes on lower selling volume than the last. This means sellers are running out of strength. Bearish divergence. Price makes new highs, but each new high comes on lower buying volume than the last. This means buyer enthusiasm is fading, even while price keeps climbing. How to spot it. Compare the last 2 or 3 swing highs or lows on the chart. Compare the volume bars beneath each one. If price continues its trend, but volume is trending in the opposite direction, that's divergence. Case study. In late 2021, many high-growth tech stocks, including several held in the ARK Innovation ETF, were making new highs, but each new high came on progressively weaker volume. That was an early warning sign that surfaced weeks before the broader tech sell-off of 2022. Traders who only watched price momentum kept buying with the herd. Traders who noticed the volume divergence exercised caution. Conclusion: thinking apart from the herd. So here's the real question. Why do most traders fail? Because they only look at price, a one-dimensional view. They chase the trend while volume is quietly warning them. They buy during a climax, right when smart money is selling. They sell during capitulation, right when smart money is buying. Volume analysis isn't a magic indicator. It doesn't guarantee a win rate, but it gives you something most price-only traders don't have: a second dimension, context that price alone can't provide. Remember three things. 1. Price tells you what happened. Volume tells you how genuine it was. 2. Always look at effort and result together. The mismatch between them is where the real signal lives. 3. Stopping volume, buying climax, and divergence all tell you what large players are quietly doing, even before price fully reflects it. Next time you open a chart, look at volume before you look at price. That single habit is what separates you from the herd. In the next video, we'll cover how to actually build these patterns into a trading strategy: entries, exits, and risk management.